we can't fathom, because it hasn't happened in our lifetime, we can't fathom that tax rates could go dramatically higher than they are today.
So I'm thinking, okay, if we get a little longer runway here, the next maybe eight more years of lower taxes, then it gives people an incredible opportunity to start slowly moving or methodically moving money from taxable to tax free. And Dave, I'm not telling you anything that you haven't been preaching, probably to the point where your wife is like, Dave, will you quit talking about this, please? I don't talk about it with my wife.
Right. I think people they just don't realize how low taxes are today. They don't realize we're at historically low tax rates because maybe they're just not old enough to remember when tax rates were much higher. I mean, I know you love to tell the story of your parents back when what tax rates were in the 70s, but people
Yeah.
forget that the highest marginal tax rate in the 70s was 70%. Highest marginal tax rates in the early 60s was 89. In the wake of World War II, it was 94. And so we can't fathom, because it hasn't happened in our lifetime, we can't fathom that tax rates could go dramatically higher than they are today. And we have to remember that tax rates ebb and flow over time.
Tax rates are at the lowest they've been in our lifetimes for sure. And you mentioned the top marginal brackets. It's not so much about the top, it can be the bottom. They kind of float up together, mentioning my mom and dad's tax return from 1973, before my sister was born. Three boys at home, combined income $16,000, a standard deduction of $2,500 per kid, and they still paid $2,600 in federal income tax, 20%. So it's not just about all the people making all that money, but it's also the bottom brackets as well. So let's talk about some of the things and strategies and gotchas that we need to inform people about when it comes moving from taxable to tax free, Dave.
Well, there's a temptation to say, "Hey, look, I've got all this money in my tax deferred bucket. It's a ticking time bomb. I'm in a business partnership with the IRS, and every year they get to vote on what percentage of my profits they get to keep, and so not a great business partnership." So there's this sort of urgency to get all this money shifted to tax free and to do it as quickly as you possibly can. But you got to remember that the whole goal is to shift this money slowly enough that you don't rise into a tax bracket that gives you heartburn, but quickly enough that you can get all the heavy lifting done before tax rates go up for good. And I saw a lot of people back when we thought that tax rates were, before anybody thought that Trump was going to get reelected, when they were talking about tax rates, the Trump tax cuts expiring, people are trying to get $1 million worth of Roth conversion executed in 2 years, and they were rising into these huge tax brackets to be able to pull it off. And so really you got to stretch that tax obligation out over as many years as possible. And now that it looks like the Trump tax cuts are going to get extended, we now have, if you count the year 2025, you now have 9 years during which to take advantage of historically low tax rates once those tax exemptions go through. And so I'm a huge fan, as you know, David, of the 24% tax bracket. I think that's the sweet spot on the Trump tax cuts. The 24% is still lower than the future version of the 22, which is 25. And the 24 is only 2% more than the 22, and it allows you to go all the way up to $394,000 of taxable income. So that's an extra 188,000 in that above and beyond the 22% tax bracket. So if you've got huge amounts of money in your IRA, avail yourself of the 24% tax bracket, because for 2% more, you can get all that extra heavy lifting done and take advantage of a historically low tax. I think that come 2034, David, we're going to look back on the 24% tax bracket as a good deal of historic proportions. And so I think that really is the sweet spot in the Trump tax cuts.
Well, I'm definitely a Rothaholic. I've admitted to that. I've even went to my whatever they call that, Rothaholic Anonymous or whatever, to make sure that but I don't want to be cured of it. The other thing that was going to sunset was the federal estate tax as well. We were at 12, $13 million. It was going to get cut back in half. So we had a lot of people who were, owning businesses and different things that were worth 20, 30, $40 million, like panicking to do some really crazy and creative planning because the IRS said, well, we will not claw back on that. Haven't really heard much about the federal estate tax. I'm assuming it would stick where it is today. And I've told people, listen, you might just tap the brakes a little bit until after the election and see before you do any crazy planning. But you never know. The federal estate tax has been all over the place since I started in 1994. It was $600,000 per person. It went to $1,200,000, $510,000, went away to zero under Bush number number two, and then back to I think five, and then to 10, and I mean, so it's been all over the place as well, not just our tax code. So, any thoughts about the federal estate tax?
Because it's not about what your net worth is today. It's what your net worth is going to be when you die. And so you may not think that you have an estate tax problem. So you have to run the numbers out and say, what is my net worth likely to grow to over the balance of my life? And then you're predicting two things. What is my net worth going to be when I die? And what is the tax landscape going to look like when I die? That's like trying to hit a moving target in the dark. It's pretty hard to manage. But this much I can say, David, is that as we slowly slide into insolvency, I think they're going to be looking in all quarters for new revenue. And I think that the estate tax is definitely something that they're going to use to infuse more revenue into the system.
And the Roth IRA does not protect you from that, but you could use a life insurance policy in a trust that would be tax free. And I think life insurance, I don't think that's, I mean, maybe the accumulation of cash, maybe that could be, because that has popped up a few times, in the last 20 years. But I just don't see IRS code 7702 being thrown in the ditch when it seems to be, the most sacred of the tax code, and that's the tax free treatment of life insurance. What's your opinion of that?
Yeah, they floated about every 8 or 9 years. They floated it with the Simpson Bowles, and then of course the lobbyists from the life insurance companies sort of sprang to life and shot it down from about 12 different directions. So they floated. It's a huge source of it's a huge not a source of revenue. It's a huge hole in the U.S. government's revenue that they miss every single year, and so it always pops up as something that could come under the scope were they to really try to get their house in order. But I think that every time it's happened, it's gotten shot down.